Bitcoin isn't just volatile, it's a roller coaster built on rocket fuel. Just look at its wild history. Back in late 2017, Bitcoin didn't just rise, it exploded, soaring 525% in just 3 months. But just as fast as it went up, it crashed, plunging 66% by early 2018. Then came 2020. From the COVID lows in March, Bitcoin launched into orbit, skyrocketing over 1,100% in 1 year. And once again, gravity kicked in. Between late 2021 and late 2022, it collapsed 77% from its peak. The fast rise in Bitcoin's price can be exciting, but the frequent crashes can be nerve-wracking. It makes people wonder, why is Bitcoin so volatile? Hi, my name is Eugene, and today I'll explain the 7 reasons why Bitcoin is so volatile. The main reason Bitcoin is so volatile? It's fueled by something called animal spirits. Basically the raw, unfiltered emotions of retail investors, like you and me. When Bitcoin's price starts rising, something funny happens in our brains. We get excited, we get optimistic, and we start thinking, I don't want to miss out. So more people rush in to buy Bitcoin. More buying pushes the price even higher, which makes everyone even more excited. That's a classic positive feedback loop. But it works the other way too. When Bitcoin starts falling, optimism quickly turns into fear. People panic. They think, get me out before it goes to zero. So they sell fast. All that selling pushes the price down even further, creating a downward spiral. The famous economist John Maynard Keynes had a name for this behavior: animal spirits. It's the idea that investors aren't always rational. We chase winners, dump losers, and let emotions drive our decisions. And when emotions are in control, prices can swing wildly, which is exactly why Bitcoin feels like a financial roller coaster. Another reason Bitcoin is so volatile is algorithmic trading. On Wall Street, many trades are no longer made by humans, but by computer programs. These algorithms are designed to spot patterns and react instantly. One simple pattern traders noticed long ago is called momentum. When an asset goes up today, it's more likely to keep going up tomorrow, at least for a while. So a very basic algorithm does exactly that: buy when the price is going up and sell when it's going down. This strategy is known as momentum trading. The problem? These algorithms end up doing the same thing humans do, chasing winners and dumping losers, but they do it faster, automatically, and all at once. That speed and coordination can push Bitcoin prices higher even faster and crash them even harder. And that's why a lot of Bitcoin's volatility can be attributed to algorithmic trading. The third reason Bitcoin is so volatile is the media. How many times have you seen headlines screaming, Bitcoin hits an all-time high? The media loves to pour gasoline on the fire because excitement means clicks, views, and ad revenue. Social media does the same thing. On platforms like Reddit, Instagram, and X, people constantly hype Bitcoin. Some influencers already own crypto, and others are paid to promote it. All that attention pulls in even more buyers, pushing prices higher and higher. And of course, it works in reverse. When Bitcoin starts falling, the headlines suddenly switch to crypto meltdown or Bitcoin crash. That negative coverage spreads fear, triggers panic selling, and pushes the price down even further. Once again, it's the same feedback loop, just running in the opposite direction. The fourth reason Bitcoin is so volatile is we still haven't figured out what its intrinsic value actually is. If you buy shares in a lemonade stand, it's pretty easy to value. You check the sales, subtract the cost of labor, sugar, and lemons, and you come up with a fair price. But Bitcoin? It has no earnings, no cash flow, no balance sheet. This creates a massive canyon of opinion. In the left corner, you have the believers like Tom Lee and Cathie Wood. They see digital gold. They see the future of money. They genuinely believe each Bitcoin is going to be worth $1 million. In the right corner, you have the legends of traditional finance, guys like Warren Buffett and Jamie Dimon. They look at Bitcoin and see rat poison. They think the fair value is exactly zero. Think about that gap. We aren't arguing if a stock is worth $100 or $150. We are arguing if each Bitcoin is worth $1 million or zero. When you have a market torn between it's the future of civilization and it's literally nothing, you don't get a steady price line, you get a tug of war. The price is just violently bouncing back and forth between those two extreme realities, trying to figure out which one is true. The fifth reason Bitcoin is so volatile is low liquidity. There are only about 20 million Bitcoins in existence today, and there will never be more than 21 million. That cap is hard-coded into Bitcoin by its mysterious creator, Satoshi Nakamoto. This was a genius design choice because unlike fiat money, whose value can be eaten away by inflation caused by money printing, Bitcoin can't be diluted by oversupply. But here's the catch. Scarcity cuts both ways. Fewer Bitcoins means less liquidity. There just aren't that many coins available to trade at any moment. And it gets worse. About 20% of all Bitcoin is believed to be permanently lost, locked away forever by forgotten passwords and misplaced hard drives. So picture this. A hedge fund dumping $200 million into the S&P 500, that's a pebble in the ocean. The same $200 million hitting Bitcoin, that's a cannonball in a swimming pool. Prices don't move smoothly, they lurch, and that's why Bitcoin can jump or crash so violently. The sixth reason Bitcoin is so volatile is leverage. Crypto exchanges let traders borrow money to buy Bitcoin. Sounds exciting, and it is, until it isn't. Leverage is a double-edged sword. When Bitcoin goes up, leverage turns small gains into huge wins. But when Bitcoin goes down, it does the same thing to your losses, only much faster. And here's where things get ugly. If your losses cross a certain line, your exchange sends you a margin call. Add more cash right now, or we sell your Bitcoin for you. Most traders don't have extra cash lying around, so their positions get liquidated, forsold at the worst possible moment. Those forced sales push prices down even more, triggering even more margin calls and even more liquidations. It's not a dip anymore, it's a liquidation avalanche. That's why leverage doesn't just increase risk for one trader, it supercharges volatility for the entire Bitcoin market. Finally, the seventh reason Bitcoin is so volatile is government regulation. How many times have you seen a massive green candle on a Bitcoin chart right after a government announces something positive for crypto, such as approving spot Bitcoin ETFs? And how many times have you seen Bitcoin crash overnight because a government suddenly tightened the rules? Governments around the world are still trying to figure Bitcoin out. Is it good for the economy because it offers protection against currency debasement, or is it mainly used for speculation and criminal activity? There's still no global consensus, and because of that uncertainty, regulation keeps changing. Every new policy headline, approval, ban, lawsuit, or tax rule hits the market like a shock. That's why Bitcoin doesn't move calmly, it reacts to headlines. These are the 7 reasons why Bitcoin is so volatile. So what does that mean for us? Historically speaking, Bitcoin's wild volatility has been very well compensated by its returns. From 2011 to 2025, Bitcoin delivered an average annual return of about 96%, while the S&P 500 returned roughly 17% per year. That's not a typo. But, and this is a big but, past performance does not predict future performance. Still, one thing I feel confident about is this: Bitcoin's volatility isn't going away anytime soon. Remember, the mysterious creator of Bitcoin, Satoshi Nakamoto, has never moved his coins. If one day Satoshi wakes up and makes a single transaction, it wouldn't be a ripple, it would be a tsunami. And that's the double-edged sword of Bitcoin. Gaining 1,100% in a year feels amazing, but losing 77% can absolutely destroy you financially if you're overexposed. That's why, for most people, I don't recommend putting more than 10% of your portfolio into crypto. Bitcoin can make you rich, but volatility doesn't care about your feelings. That's it for today. Thanks for watching. If you enjoyed the video, hit the thumbs up and don't forget to subscribe. I'll see you in the next one.